Robschild. Welcome to the portfolio update. It's been a month since my last portfolio update, so I'm due for one. Here are the crystal ball ratings and my portfolio update. Hopefully you watched the most updated macro show. It is imperative to watch that show. If you watch anything on my channel, the most important things really are my chapter review of every chapter of security analysis. That's number one. And number two, my macro shows. This is tertiary, I will call it. But I do understand if all you want to do is watch this video because it's the icing on the cake, and who doesn't want to just eat the icing off the cake? Crystal ball ratings begin. S&P 500 currently priced like a Ponzi scheme. If you watch my macro show, you understand some of the details why I am saying that it is priced like a Ponzi scheme. A Ponzi scheme meaning that it is relying only on somebody tomorrow to pay a higher price than what you paid today, and we're just chasing each other around the merry-go-round until whenever the music stops and people realize that the valuation is not backing up the current price. The Fed won't cut fast enough to save the economy, although they have cut 100 basis points, and it was enough to uninvert the yield curve. We have some semi-normalized yield curve. The Fed stopped strangling the economy. For a long time, when it was inverted, I had said every show, the Fed is still strangling the economy. Now that we have the normalization of the curve, it stopped strangling the economy, and it's waiting to see if it's still alive or not. If it needs to strangle it some more to get inflation to stay under control or not. My viewpoint on this is that we're on the other side of the mountain now. That we had post-COVID. Post-COVID, enormous fiscal stimulus. The rates were down to the floor. They were doing massive amounts of quantitative easing, which means they were buying treasury bonds in order to keep borrowing costs really low, keep money cheap so that the economy wouldn't fall apart. They said, we want to see inflation go up, go sideways, and then go up some more. If you listen to the speeches, he said this. This is something that I talk about on my show often, and I don't hear many other people talking about, but that is how it worked out. The Fed wanted that spike of inflation so that yields could go higher, so that they have more wiggle room to go down and down. We don't have high birth rates. What else can, keep inflation going? What else can keep rates from going down to a Japanese style super uber low rate environment? We're definitely still headed there. But the point is that what has happened since that spike of inflation? Okay, we've been strangling the economy. Now inflation has spiked downwards, and then we paused. Remember, we went up, we paused, and then we went up again, right? So now we spiked down, we paused. Well, what's next? Well, is the Fed continuing to ease monetary policy? No. They're waiting. And the fact that it is above the inflation rate is one metric to say that, maybe the Fed is sort of still strangling the economy here, even though the yield curve is normalized. But I am reading between the lines of the way the Fed has been operating, and I'm seeing, they're waiting now for inflation to tick back down. That's what they said. They're going to keep rates steady until they see further progress. In the last meeting, the very most recent meeting, the notes coming out said, they took out the part saying that we are seeing more progress towards the 2% inflation goal, which means we're waiting for it to start ticking down again. That's where we are. It's just how it is. It's so easy to see. I don't even need my crystal ball. I see it in plain daylight. The Robschild portfolio, it hasn't really changed very much for a long time. Again, this is not advice. Any decision or indecision that you make is all of your own responsibility. Make sure that you always know that. With that said, I have personally 59% of my portfolio in long duration treasury bonds. The popular fund is TLT, but I own ZROZ and some TMF. Again, this is largely based on where we are in the business cycle, number one, and also the valuation of the S&P 500 compared to bond yields. Benjamin Graham in Security Analysis, when he's comparing the value of stocks and bonds, he uses specifically AA bond yields and compares that valuation to what the earnings are on companies. And right now, with the PE ratio being 30 and AA bonds yielding about 5%, it's a mismatch. It doesn't make sense. And where we are in the cycle and everything, it just kind of suggests to me that one or two of two things needs to happen. Yields need to go lower, and or stock prices need to go down in order for things to be balanced out, unless we had an explosion of earnings, which I'm not seeing. Earnings have been flat. Again, watch the macro show to get details on that. I only use charting as I know my daily show uses a lot of charts and I talk about them, but this is third tier for me. I don't use charting as my primary way of making decisions, but I do know a good amount about trend lines and Bollinger Bands and moving averages and all of that. And I can say that I recently actually came across another way of looking at the Head and Shoulders. I had previously had a line connecting these 2 points as here it is. This blue line here was my previous Head and Shoulders top. I was thinking shoulder, head, shoulder. We broke the neckline, retested it, and I thought we were headed down to the target, but instead we broke above it, we broke below it, and I just realized that this line looks a little bit more like it makes sense if you take this recent top here, connect it to this part of the neckline. Perhaps this Head and Shoulders top is actually being retested right now. Maybe this is actually the end of the retest of the Head and Shoulders top here. We also have resistance points, major pivot points here at 4.74 and also all the way here up here at 5%. But the point is that when the 10-year note yield drops, that's when the value of TLT goes way up. And so the way I see it right now, I've adjusted some lines on here very recently. It looks like we are within sort of this channel here. Rising channels tend to break down to the downside, by the way. And on the extreme short term, this chart showing September 2024, connecting these two lines here, we had bumped our head on it a little bit, breaking over it a little bit today. This line, may or may not still be valid, but I see this Head and Shoulders top here, this little one that broke down. We haven't played it out till the downside yet. Generally speaking, we're on the upper range of where we've been over the past 2 years now, suggesting to me that it's likely a decent time to own treasury bonds. Combine this with the fact that the U.S. economy, generally speaking, since the 1980s, has been getting very accustomed to borrowing costs getting cheaper and cheaper and cheaper. You can refinance your house. You buy a house at a certain rate. You can always refinance it at a lower rate. Because that's how it's been for many decades at this point, just dropping lower and lower and lower. We actually were in a parallel channel for quite a long time here. If we put this line here, you can sort of see what I'm talking about here. And we have popped back out of it. Notably, zero is important, which is right where my mouse is right here now. And this is what the Fed was afraid of. We don't want the Japan thing where we're at zero or negative rates. That's it's not a good position to be in. But the demographics of an aging, continuing aging economy, or aging population rather, that's typically what happens with lower and lower yields as you don't have the demand that you need to keep things going. I think that yields have gotten crazily overextended. That combined with the fact that, longer yields spike down whenever you do get a major recession or depression, all of it combined says to me that, I like treasury bonds. They seem to be undervalued in every possible way that you can look at it. And that's why I have 59% of my portfolio in 0Z and TMF. I also have 10% of my portfolio in Brazilian equities, specifically the funds EWZ, EWZS, and some leveraged BRZW. While the S&P 500 seems enormously overvalued, this emerging market does not seem overvalued at all. Its current dividend yield, EWZ itself, is 8.7%. I mean, that's in line with, normal stock valuations of, a long time ago, compared to the 1.23% that you can get for the S&P 500. That alone makes this a really attractive investment for me. The PE ratios of these companies suggest that these companies are extremely cheap. And not only that, you have something called a long underinvested market. Again, Benjamin Graham in Security Analysis discusses decent places to be are areas that seem undervalued for an extremely long period of time. They're set to have their heyday at some point. And if we take a look at EWZ, it certainly had a heyday in 2008. This fund, EWZ, getting up to a level of price in dollars at $100 per share before the great financial crisis and collapsing down. But very notably, since this period, while the S&P 500 has just gone vertical to the sky, we haven't seen Brazilian equities this cheap since before this bubble. I guess it looks like a bubble in retrospect. We haven't seen this price as far back as 2005. Imagine being able to buy any stock for the price that it was in 2005. Imagine being able to buy the S&P 500 at 2005 prices right now, today. It just seems very obvious to me that this is a massively undervalued market. The country itself, Brazil, they produce a lot of metals. They produce a lot of energy. They produce a ton of food, especially for China, which apparently is showing little signs of recovery. Everything combined together tells me to be very happily invested in Brazilian equities. And as much as I like EWZ, I also like EWZS. It's like the small cap version of Brazil. They tend to move together, but small caps have higher beta. And so if Brazil gets a big boost of investment, the price of the smaller cap companies will go up much more than the price of the regular EWZ. And then BRUZ is actually a leveraged fund, and so that's based on derivatives. And so, with something this undervalued, looking like it's ready to pop any time here, why not get a little bit of leverage? I'm not sure Graham would agree with taking that stance, but I'm not Graham. I'm Robschild. I'm going to do better than Graham. Similarly, in China, the holdings of KWeb include, the Alibaba, Facebook, Amazon, you name it, tech giant company of China. They're all in this fund, KWEB. The PE ratios are enormously tinier than their counterparts in America. The valuation discrepancy doesn't make sense. It would make sense for them to equalize to some degree, but even on their own, a lot of the companies in KWeb seem overly cheap based on traditional PE valuations. I'm not going to break them down in this video, but I will tell you that I've calculated on my own that a still cheap but more fair price of this fund in my mind is around the $50 range, which, it would get a very nice gain from here if that were to occur. The way that I feel about it is I feel like it's been a balloon held underwater, and I just want it to rise to the surface to sell it. I'm not looking for it to go to the moon. I just want it to get back to the surface, revert to a normal state. That's how I play this game. I like the safety of it, and if people say, okay, it's not safe because it's China. Business is the world. Do you want to own the world? Do you want to own the production of goods and services? Benjamin Graham says, don't get too scared of political risk, especially when it comes to stock valuations. He doesn't like foreign government bonds, but he has no problem with equities because at the end of the day, they produce stuff and it's worth money. It doesn't matter what happens to their currency, if it goes up or down or sideways. It's the value of the stuff that they're producing and the profits they're able to make. That's what you're owning. That's what you're purchasing. My original intention was 10% in the fund K-Web with a little bit of C-Web too. There's a leveraged version of that. It's blown up on its own to 13%. And again, I'm waiting for this to get around to the $50 range for me to sell. I also have a 5% stake in Nissan stock. The reason I like Nissan stock has to do simply with the balance sheet. All right. Current assets. That means how much it's basically inventory, the value of the cars they have, plus the cash they have. And it's in the thousands here. So it's millions, billions. It's definitely not $12 trillion. So it's 12 trillion yen of current assets versus all of the money they owe, which is only a little bit more. This says to me that this company is perfectly healthy. And then what I like to do too is take a look at the non-current assets and the PPE. So this is sort of made up by land, buildings. They have tons of machinery. This is not worth nothing to me. And the market right now is pricing the stock as if it's worth absolutely, it's not just worth nothing. It's like a liability that if they try to sell all of their land and their machinery, they're just not going to get anything for it. And that presents a very attractive opportunity for me. I think that, okay, so management has come out and saying, oh, we can only survive another year. We don't know how we're going to do it. And I say, I'm going to take a look at your balance sheet, and I'm thinking you're doing one of two things. You're either poop and scooping. It's a real thing. Look up poop and scoop. It's a investment phrase. It means you try to say things to make the price low so you can scoop up all the shares before your company's doing well again. I think that we could be seeing an operation like that. Otherwise, the way I look at it is that this company is just way overly pessimistic. I don't think this company is going completely bankrupt, and if they really do believe that they're headed to zero, then liquidate and give me some of the money left over from the machinery and the land that you sell, because the stock currently is priced so that it's lower than the total amount of current assets plus half of the PPE. One last piece to Nissan, they did well in the dot-com bust, actually. The stock performed well. And so if we see a similar AI bust, I don't know, that's more of a crystal ball rating, but Next, rare earth metals. There's a fund called REMX, which I have 6% of my portfolio. It looks very similar to, I'm not even going to bring up the chart, you can look at it yourself. It looks very similar to the Brazilian chart. They got a big valuation in 2011, and it went up like, I'll just bring up the chart. So it was at $345 a share of this specific ETF. This is a collection of companies that produce all of the stuff that we need for all these fancy batteries and electronics, all of the rare earth metals. These are companies that produce those rare metals. And in 2011, the price of all of these companies in this fund combined was at $347 a share, and right now it's $40 a share. So again, this is another like really obvious place to me that's screaming like there's not enough investment in this. People are scared to invest here, and maybe rightly so. When you see, if you were invested in this in 2001 and held it through to 2016, which, of course, like there were tons of people buying here at the top in 2011 and selling in 2016 when they gave up. There's a lot of pain. There's a lot of pain in this market, and once the pain subsides, I expect to revert to a more reasonable valuation, which I assume is quite a lot higher than the current price of $41 per share. And then the rest of my portfolio, I have 3% in basically cash, slowly moving more into T-bonds. When I get more obvious signs that things are slowing down, if CPI report is super low tomorrow, I may continue leveraging into long duration treasuries, but I like having a little bit of cash at the moment. I also have 3% of my portfolio in put option contracts, leaps actually. Most of them they actually expire January 2026. Between $73 strike and $78 strike, by the way, specifically. I don't think I've mentioned that on the show before, but those are the contracts I'm buying and that I have. On HYG, again, watch the macro show to understand why I think this is a really great position in terms of credit spreads, but I'll add to this that when I have puts on junk bonds, it's a heads I win, tails you lose kind of situation with me playing against the market. All that has to happen if economy is doing great, things are heating up, inflation heats up, what happens? Yields go up. That puts pressure on HYG to go down in price. Not a lot. The duration's only 5 years, but still there is pressure there, and as pressure builds for having to pay more because of the yields being higher, that can snowball on itself. But also, if the economy is indeed headed into a major recession or depression, and you get credit spreads blowing out, then the value of HYG also goes down. So it's like no matter what happens, I don't think HYG can maintain its current level with credit spreads being so enormously tight right now. I love being in that position. Absolutely love it. I also have 3% of my portfolio in other assets, including a little video game company I like called OTGLY, and also MSOS. This is a U.S. cannabis index. We went from a price of $55 when this was getting really popular, and now we're like between $3 and $4. It just seems so overly done on the other side that I'm willing to put some capital in there and just sit on my hands and wait for people to, stop being as scared as this is just, I love this. I love Mr. Market in here, how excited he is about, cannabis stocks on one hand, and like how tragic it is at this point that it's lost, what is that, 95% of its value, something like that. It will recover. I can see it pretty clearly. And that's all from me and my crystal ball. Again, none of this is advice. Do your own homework, make your own decisions, and that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.